We are absolutely delighted to have and to welcome back Mickey Bowman, Vice Chair of Supervision at the Federal Reserve Board. And we've had the pleasure of having Vice Chairman Bowman here at the Passero Center in the past, and just delighted to have you here again. You have a very ambitious agenda, right? There's a lot going on, and the world is watching, with both your hats on, your role on the FMC and your role as the Vice Chair of Supervision. So if we might, let's start with some, I'd love to hear your thoughts. The audience would love to hear your thoughts on the macroeconomics, and what's going on in terms of how you're thinking about interest rates, right?
Okay.
So as we think about inflation and unemployment, right, the labor markets, the Fed has a dual mandate looking at both of those. And so what are the key factors that you're looking at in terms of deciding how many more rate cuts are needed? Is it 3? We've had one already last week. What is your expectation about rates and what's happening in the markets?
Well, first of all, Rena, thank you for inviting me to come back to the Soros Center to discuss, one, our agenda, and two, also the importance of our monetary policy decision making, especially now as we're seeing some deterioration in labor market conditions. You asked about my thoughts and forecast on rate cuts for the rest of the year. Earlier this summer, I mentioned in a speech that I had penciled in 3 rate cuts back in December of last year as we were thinking about how we were forecasting how the economy would evolve in 2025. I think as the economy, and that's because I expected that we would have close to a soft landing, that inflation would return to 2% or close in that vicinity, and that we would see the economy remaining strong. Over the course of the last 6 months or so, what we've seen is that labor markets and labor market data has shown us that we have a more fragile labor market than we were expecting to see, with about 25,000 jobs created over the past 3 months due to BLS revisions, which is an issue, I think, as we're thinking about monetary policy making and trying to rely on data that's reported. So as we're seeing some fragility emerging or persisting in the labor market over the past few months, in my mind, I think as we're also seeing that inflation has hovered relatively close to our mandate, especially when you take out the effects of trade policies and tariffs, I think we're close within range of what our mandate is, close to 2%. And we should be shifting our focus to preemptively and proactively support labor market conditions as we're seeing these conditions become more fragile. So in June, or at our July meeting, I dissented from the policy decision, which was to stay at the same rate that we were at that time. Because at that time, I thought it would be appropriate for us to shift our focus away from inflation and to what we were seeing as gradually, I think, evolving fragility in labor market conditions, as well as declining payrolls data. So, of course, as we were coming into this meeting and we continued to see that data declining, it's appropriate now for us to start implementing rate cuts. And I supported the language that was included in our post-meeting statement that indicated that we would continue to consider further adjustments of the policy rate as we saw the data continuing to come in. So in my mind, I think that means that we may come to see 3 rate cuts by the end of this year, as I had initially projected in December of 2024.
What data do you look at? How do you balance your dual mandate, inflation on the one hand and the labor markets on the other hand?
Well, I think as we've seen inflation declining from the extraordinarily high levels that it was during COVID, at the time that we were raising the policy rate to address those conditions, we've come within a very close range of our 2% target. So in my mind, I'm less concerned about whether we're going to achieve our 2% target than I am about deteriorating labor market conditions. I think when we see that one of our mandates is the conditions are more fragile than potentially the other side of our dual mandate, then we should be refocusing our monetary policy decision-making to focus on, one, bringing our policy rate closer to neutral so that we're not unnecessarily restricting economic conditions based on where the policy rate is. So in my mind, I think we have some space to bring down the policy rate closer to neutral so that we can support the labor market.
You mentioned the word tariffs. So initially there was a lot of concern about what tariffs might do to inflation. How has your view changed on that?
So I think there's a lot of economic or academic research that shows, and also historic evidence that shows that tariffs generally have a one-time price level effect. And so as the trade agreements have come to fruition and we've seen more certainty in that way, my expectation is that we'll see potentially one-time price effects, but it won't continue to increase or persist in the level of inflation.
Mm-hmm. So you're feeling much more confident about tariffs not having a huge impact on inflation? It'll be the one time. Has that one time happened, or it's to come?
Well, I think that there's a continued path of these trade policies and trade agreements with different countries being agreed to. I think we're also seeing that a number of the foreign suppliers are taking on the cost of some of those tariffs. And I think we're seeing U.S. businesses deciding to shift to non-tariffed countries or lower tariffed countries to find supply opportunities.
We could keep talking about monetary policy issues for a while, but you have a very important hat on as the vice chair for supervision. And you really have a very ambitious agenda there.
We do.
So let me just ask with a broad question. What are your immediate priorities? What do you want to get done in the near term?
Well, thank you for allowing me to do the first speech after I was confirmed by the Senate to lay out my priorities here at the Soros Center on June 4th. So you can read that at your leisure if you have an interest in doing so, but I did lay out an ambitious agenda at that time. Some of the things that are on necessities that we need to accomplish are right-sizing and addressing the large bank capital requirements. So on July 22nd of this year, we hosted the first of its kind capital conference at the Federal Reserve, where we invited members of academia, we had industry experts and others come and talk about how they've been experiencing the capital requirements, whether it's stress testing, whether it's GSIB surcharge, the Basel III proposal, and other aspects of the capital requirements. So that gave us a great foundation to make sure that as we're addressing all four pillars of the capital requirements for the largest banks, that we understand how they interact and how they're, as we're looking to make changes or to adjust each one of those individual components, that we understand how they might impact each other, and so that we're arriving at the end of the day on a comprehensive evaluation of where capital levels should be for banks of that size.
Yeah, that's really interesting, because a lot of criticism against regulators tends to be about you come up with this regulation and that regulation, and they're all in silo, but nobody's looking at what is the total impact of all the, in a comprehensive way, looking at what is the total impact of all of this.
Well, I think it's 15 years later, right, since Dodd-Frank was originally envisioned. And we've experienced it for a number of years, and the banks have been complying with it for, at least since that time. And I think we have a good perspective on what's been working, what could be improved, particularly in stress testing. As you know, we have a number of regulations and a body of work that we have committed to doing as a result of some lawsuits that the industry's filed against us.
So, yes, you gave your speech here at the Pissarro Center, and of course we were delighted to host you. And you touched upon a lot of different issues, right? Again, a very ambitious agenda. Can we go through some of those? So, ratings. I remember one of the things you said, that the large banks get really bad ratings, and it doesn't make sense that they get these ratings, and the ratings have a huge impact. So what kind of changes should we see? You've said something about reputational risk, right? And also transparency in ratings.
So let's start with the proposal that we published earlier this summer on the large bank framework for the rating system that applies to the holding companies of the large banks. Initially, in 2019, when that structure was introduced, it created 3 different buckets for analysis. One was capital, liquidity, and the other one's governance and controls. I think as we've seen, as it's been implemented, we've highlighted, instead of those areas that lead to bank failures like capital and liquidity and other financial matters, core financial risks, we've been highlighting and focusing on some of the operational aspects of a bank's performance instead of focusing and using that financial risk as an indicator of the well-being of a bank. So that proposal that we passed at the board, and it will eventually be finalized later this year, is to reset that framework to ensure that when we're talking about lowering the condition or the rating of a financial institution, that it's relying heavily on at least one component being a financial related component.
Okay, okay. And you've talked about transparency in ratings.
Yes.
So that the banks understand exactly how they're being rated.
Mm-hmm. So one of the other things that we're looking at too through the FFIEC, which is to review the CAMELS rating system. And that includes the members of the other prudential regulators, the NCUA, as well as the State Liaison Committee from the Conference of State Bank Supervisors and those folks from across the 50 states that oversee banks in their states. So we're looking at ways that we can make sure that there's clarity and transparency in each one of the components to understand how those are being weighted to come up with each one of those individual ratings categories, but also how they're being brought together to indicate what the composite rating would be for a financial institution.
And so this should result in huge changes in ratings?
I don't know that it necessarily will result across the board in huge ratings and changes, but I think what it will do is provide more certainty and clarity for financial institutions as they're going into an examination, so they understand what categories and how we're thinking about different components of the rating system. I think as we do change the LFI system, because right now the majority of banks that are not considered to be well managed, it's because of one category and it's because of governance and controls, which is not related to the financial condition of the bank itself. So this just puts more appropriately the weighting of its condition on how its financial condition is.
Okay. Another thing that you've said is, in my words, the way I understood it is one size shoe doesn't fit all,
Correct.
right? And you want to tailor regulation based on what size you are, if you're a community bank, in different buckets. Can you talk a little bit more about that?
Sure. So tailoring was something that was introduced in, it's called Senate Bill 2155, and it required us to consider, as we're thinking about supervision and regulation, the complexity, the asset size, the business model, and the risk that an institution presents to the financial system. So, you're speaking about community banks in particular. I think it's broadly known that community banks that are defined as $10 billion and below, as long as they have a relationship business model, don't pose a risk to financial stability. So in that way, it's important for us to understand that it's not appropriate to apply GSIB type requirements, the largest bank requirements, for trillions of dollars of assets of banks and extraordinary complexity to those smallest institutions. And in some cases, we've done that. And I would point to the most recent Community Reinvestment Act proposal. And actually, the current implementation of the Community Reinvestment Act does equate some of the smallest institutions to some of the largest in some of the requirements that are within that rule.
And you have a roundtable coming up on community banks.
We
What
do.
are you looking forward to achieving there?
So the July 22nd event that we did for the Large Bank Capital Conference was the first of its kind for large banks. We're doing the same thing for small banks. On October 9th, we're hosting a community bank conference where we're bringing in CEOs from, I think most folks would think that it's a bit unique in its aspects because we have the CEO of Blackstone coming, the CEO of Paxos and Robinhood, as well as some panels on community banks and capital and liquidity requirements, things of that nature, to have a day where we're discussing issues that affect community banks and to help them think about the future. Kind of the same way when we invited Sam Altman with OpenAI to come to speak at the Capital Conference. It was an opportunity for us to shift the conversation to what does the future look like? How should we be encouraging banks to think about innovation? AI in their business models. How could we think about the evolution of the financial system and making sure that we're thinking about it before it happens?
So you mentioned technology, innovation. So in this world of, the financial sector has always used a lot of technology, has been at the forefront of technology. But there's a massive shift happening right now with artificial intelligence and other things. So how do digital assets, we just had a panel on digital assets. So how is the Fed integrating these developments into sort of your risk assessment and how you're going to monitor risk?
So since the dawn of time, when we've had banks existing in the United States, there has been innovation in the banking system. And I think it's been only recently that we have tried to discourage banks from innovating. And you're exactly right, Rena. All banks integrate some sort of complex technology within their business models and how they offer services. So it's important that as we're thinking about what the future is going to look like, that we have prepared our financial institutions for understanding that we can provide guidelines or guardrails that would allow them to confidently engage in these kinds of activities as we're thinking about our implementation responsibilities under the Genius Act and what that will look like for banks of all sizes going forward, but especially those that we have responsibility for. And that small banks in particular, and mid-size as well, understand that these are activities that we are not criticizing, that we want to ensure that they're engaging, but that they're doing so in a way that maintains their safety and soundness.
Yeah. And another issue that you had talked about when you were here the last time, it was you're taking a comprehensive review of capital requirements,
exactly.
right? And so given the recent feedback on Basel III Endgame and the broader discussions about capital reform, how are you evaluating the trade-offs between capital requirements, liquidity requirements, and the impact on the actual lending activity?
Well, absolutely. I think we're starting with our capital requirements because that's the body of work that's the most important with timelines that we need to accommodate. As you know, the rest of the world has introduced their Basel III proposals, and we're a little bit behind the curve on coming to an agreement on ours here in the United States. That's something that we're working on currently with our fellow regulators, the FDIC and the OCC, and trying to move forward on that with a proposal by the beginning of next year, if not the end of this year. So we're making progress on those things. As I mentioned, the stress testing requirements that we are working toward. There's a GSIB surcharge proposal that's still pending from a few years ago. And I can't remember the other. The other, should give me a second to remember what that last pillar of our capital requirements are, but we're rest assured we're looking closely at that as well as we're trying to make sure we have a comprehensive view of large bank capital. But we'll also be looking closely at mid-sized bank capital and the smallest banks as well. There is a community bank leverage ratio that applies to banks under 10 billion in assets that was authorized in the S2155 legislation that I mentioned earlier. So we'll be looking at ways to get better adoption rates for that and to have banks understand that those are activities that we're encouraging them to comply with.
So how are you making sure that a Silicon Valley Bank doesn't happen again?
Well, I have a different view, I think, than some of the reports following the failure on what actually led to the failure of that bank. And frankly, it was supervisory issues as well as some risk, not paying close attention to risk by the management of the banks themselves. I think as we're approaching the opportunity to do an after-action report on Silicon Valley Bank, we'll get a better understanding of what actually needs to be improved in addition to supervision, which we already know is an issue and is at the top of my priority list for other areas that we're working on as well. So I look forward to finalizing that I think we're calling it a review of the failure of Silicon Valley Bank and an understanding of what may need to change within our supervisory expectations as a result.
Okay. So there are some people who would say you're taking a light touch to regulation, and that's going to be bad for the financial markets. How do you respond to that?
Well, I don't think that just trying to make sure that all of our regulations work well together and are transparent and we can hold our banks accountable as well as our supervisors accountable is a lighter touch. It's not my expectation that we'll have fewer requirements or that, you know, that capital will go down as a result of the work that we're doing necessarily. But we want to make sure that all of our requirements work together to function in a way that ensures the safety and soundness of the financial system.
And where does M&A activity fit into all of this?
So I think what we're seeing already is a signal that many banks are very interested in pursuing either acquisitions or mergers, and have been for some time now. I think as we're moving forward with economic conditions going forward, it's very difficult for banks of a certain size to cross a threshold, say a mid-sized bank at $80 billion crossing the $100 billion threshold. And we want to make sure that they don't have to merge or acquire another institution in order to grow. So that's something that we're looking very closely at to understand where our thresholds are and whether our expectations are appropriate for each tier of financial institution. And that's at 10 billion in assets, 100 billion in assets, and you know, and the other thresholds that we've established in our supervisory frameworks.
You know, you mentioned a couple of times about you looking at sort of the whole picture, the whole thing. Is there more cooperation going on between the banking regulators now? Obviously, our system in the US is very complex. We have a number of regulators in each space. Is there more cooperation? I keep hearing, for example, that the SEC and CFTC need to cooperate more. And you brought up FDIC and OCC, and is there more cooperation?
Well, I know Paul is
Atkins. Paul Atkins.
Yes, Paul Atkins, but his title as the head of the SEC is speaking later today, so I'll allow him to speak about the relationships with the CFTC. But I think they are. He's spoken very publicly about the fact that they're working hard to ensure that they're aligned on a number of different issues.
But the banking regulators?
The banking regulators meet regularly. I think I have a weekly meeting with the heads of the other agencies where we're talking about different things that we're working on. So absolutely, we think it's very important. I've said before, I've been on the board now for 7 years. It's important that we are aligned so that banks have similar expectations, so that there's transparency in what they're required to do, and that we have similar applications for the way that we're implementing regulations and holding them accountable to expectations.
So do you expect that to simplify regulation in some ways?
I think it will allow the process to move forward in a more aligned and smooth way.
Okay.
Yes, absolutely.
Fantastic. At this point, I'm going to open it up for questions. And I want to ask, let our students ask the questions first. So Georgetown students, please feel free. Yeah, go ahead.
Hi, thank you so much for speaking with us today. You mentioned a little bit about the Genius Act creating a formal framework for permitted stablecoin issuers and tasks regulators with supervising reserves, disclosures, and liquidity. So I wanted to ask you specifically, how do you see the Fed's supervisory role under the Genius Act, and what challenges do you anticipate in coordinating across agencies with this new piece of legislation?
So stable coins came up in our earlier panel, and there was a lot of discussion about that. So I think that's why the follow-up.
Well, again, to reiterate what I said just a few minutes ago, I think it's very important where we're creating a new framework for a new business model, whatever that might be, if it's digital assets or some other business. It's important that we have similar expectations and similar frameworks. So we're working very closely together as we're understanding what each agency is tasked with doing, so that we can understand what they're doing, what we're doing, and how we can make sure that that's aligned. So we're very interested in ensuring that banks have the opportunity to engage in these kinds of activities, and that we're not unnecessarily putting constraints on them that aren't that might influence whether safety and soundness exists. Right? We want to create an environment where there's certainty, but also safety and soundness. So it's a little bit complex right now, and we're at the early stages. But as we're moving forward, Rena, I'm sure we'll have an opportunity to talk about that more.
Okay.
Thank you.
Okay. We'll go to this side.
Thank you for being here, Governor Bowman. Critics have argued that the Fed has at times misread the economy, in part because it relies on lagging government data. Do you believe the Fed needs to reform the way it collects and interprets information, perhaps by integrating more timely private sector data into the decisions? And then secondly, how do you think the Fed is doing in preserving its independence and credibility at a moment when many Americans are perceiving it as becoming increasingly politicized?
Well, let me start with the data issue. For a number of, I would say, years now, since COVID, it's become very clear that a lot of the data that we rely on that's collected by other agencies or other reports have not been as accurate as we would have liked them to be, and they often are revised significantly within a time frame long after a decision we would have made relying on that data. So that's been a challenge and a concern that I've had and spoken about it in all of the monetary policy speeches that I've given for at least the last 2 years. I would say that the way I approach trying to learn more about the economy is to have regular interactions and discussions with people within industries. So one of the things that I've been hearing that's been helping me understand how the labor market is faring is that businesses are still scarred by not being able to hire during the COVID experience, where there just weren't enough workers to fill out their staffs. So while we're seeing this balancing act between not hiring but also not firing workers, I think that's helping us understand how to interpret the signals that we're getting from labor market data, and where we're seeing a tick up in the long-term unemployment rate, because it's very difficult if you're looking for a job right now to get hired. So I think all of those kinds of interactions, and I know my colleagues do that as well. We have the Beige Book that I'm sure you all are very familiar with, that also helps us try to understand conditions regionally. But one thing that is extremely valuable to me, and I was just with the Kentucky bankers earlier this week, is just having a conversation with them about how they're seeing trends. And one banker said something that was really interesting, where one big change that she's noticed is that people are getting loans now for smaller dollar things that they need to borrow for. So the savings, that indicates that the savings rate may not be quite as strong as some might have thought it was. So if you've got a hot water heater that's gone out and you need $400 to fix that, she told me that she's seeing a lot more generation of consumer loans to help support those kinds of expenses. And so when you put all of that together, it helps you understand from a policymaker's perspective how to think about those experiences and how that can inform your views and judgments on monetary policy decision making. To shift from that, unless you have another question on the data, is the importance of independence. And I've said a number of times, in fact, I think right before our Capitol conference, I did an interview with CNBC where they asked me the question about Fed independence. And I absolutely agree that the Fed needs to be independent on our monetary policy decision making. It is critical that an independent central bank is responsible for making decisions about the federal funds rate and other aspects of monetary policy decision making. But with that transparency, with that independence, comes a requirement, in my mind, that we're transparent and that we are accountable for the decisions that we're making, and that we can help to the public understand how we're making those decisions and what we're relying upon when we're making those decisions.
Governor Bowman, I just want to say that here at the Passaro Center, we are this neutral place where we want to bring all the different viewpoints, not only from regulators and policymakers, but also market participants, and we provide a forum for that. And the private sector, the conversation has also been, they're asking, how can we help you? What do you need from us, right? So they are very open to that.
Right.
And the red light is flickering here and saying time is up. So we better end here. But please join me in thanking Vice Chairman Bowman.
Thank you.